So you're taking on a mortgage. It's one of the biggest financial decisions you'll ever make, right? But here's something a lot of people just don't think about. How you pay it back can be just as important as the interest rate you get. Seriously, your repayment strategy can either shoot you forward into building wealth or kind of hold you back for decades. So let's break down the options and figure out which one is right for you.
Okay, so you've found it, the perfect place. The excitement is just off the charts. But then the paperwork hits the table, and with it, this huge question: what is the smartest way to actually pay for this thing? It's a moment every single homebuyer goes through, and honestly, the answer isn't always what you'd think.
Because here's the secret, the thing most banks won't shout from the rooftops: there is no single best way. There's only the best way for you. See, the perfect strategy has to line up with your personal goals, your vision for the future. So this explainer is all about helping you find that perfect fit. And to help us navigate all this, we're drawing on some fantastic insights from the experts over at Finance and Hub Networks. They've really helped us boil it all down into 3 core strategies that every homeowner or potential homeowner absolutely needs to understand. All right, let's kick things off with the classic, the one most of us immediately think of when we hear the word mortgage. We're talking about principal and interest repayment. This is, the bedrock of traditional homeownership. To really wrap our heads around this, let's meet our first persona, the long-term homeowner. For this person, a house isn't just an asset, it's home. Their main goals are pretty straightforward: stability, security, and watching their ownership stake in the property grow year after year. Okay, so with a principal and interest loan, every single payment you make is doing 2 jobs at once. Part of it goes to chipping away at the principal. That's the actual money you borrowed. And the rest? That covers the interest, which is basically the bank's fee for lending you the cash. Think of it like a 2-pronged attack on your debt. And this is exactly why it's the go-to option for so many people. You're constantly building equity. That's the part of the home you actually own. There's a clear finish line. You know exactly when you'll be debt-free. And because that loan balance is always shrinking, you end up paying way less in total interest over time. It's all about being predictable and just making that steady progress. Okay, now let's do a complete 180 and look at a totally different strategy. This one isn't about paying the loan down as fast as you can. It's all about maximizing your flexibility and cash flow. Welcome to the world of interest-only repayment. Now, to get this one, let's meet our next persona, the savvy property investor. They see property through a different lens. It's not just a place to live, it's a financial tool. Their number one goal is to maximize their cash flow right now to free up capital for their next big move. So how does an interest-only loan even work? Well, it's pretty simple, but it comes with a huge catch. For a set period, usually about 1 to 5 years, your payments only cover the interest. That's it. And here's the crucial part. During that entire time, the original loan amount, the principal, doesn't go down by a single penny. You're not building any equity through repayments. Yeah, this slide lays it out perfectly. Just look at the difference. On the left, with principal and interest, your payment is a team effort, right? It's tackling both the debt and the interest. But look over on the right. With interest only, your whole payment is just covering the cost of borrowing for that month, leaving that mountain of principal totally untouched. So you're probably thinking, why on earth would anyone choose this? Well, it all comes down to leverage. First off, your initial payments are way, way lower, which frees up a ton of cash. An investor can use that cash for another down payment, renovations, or whatever. Plus, for investment properties, that interest payment is often tax deductible, which is a really tax-efficient move. But you're always betting on the property's value going up, because your debt sure isn't going down. All right, now for our third and most specialized strategy. This is a real power move, but I've got to say it's designed for a very specific type of borrower. Let's talk about paying your interest in advance. And for this, we need to meet our final persona, the strategic tax planner. This isn't the first rodeo. They're financially savvy, they might have just had a really high-income year, and now they're looking for smart, totally legal ways to manage their tax bill. The name pretty much gives it away. Instead of paying your interest month by month, you write one single check and pay the entire next year's worth of interest all at once, upfront. It's a bold financial move, and it can completely change the game for your tax return. And the payoff? Oh, it can be absolutely massive. The big one is taxes. An investor can claim that entire year's worth of interest as a tax deduction in this financial year. I mean, if you've had a sudden spike in income, that is huge.
It also makes your budget super simple. Your mortgage interest is paid for and done for 12 months. Some lenders will even give you a small rate discount for doing it. So, there you have it, 3 very different strategies, each designed for 3 very different goals. Which brings us right back to the most important question of all. What financial blueprint is right for you?
And really, this is what it all boils down to. You just need to ask yourself, what is this property for? Is it your forever home, where you want to build that solid, secure equity over time? Is it a vehicle for a bigger investment portfolio, where cash flow is king? Or is it a tool in a much larger tax strategy? This chart is awesome because it puts everything side by side so you can see it clearly. Look at that top row. P&I is focused on knocking down the principal to build equity, perfect for owner-occupiers. Then the middle row, interest only just focuses on the interest to keep your cash flow high. That's ideal for property investors. And the bottom row, interest in advance, lets you prepay that interest for a big tax deduction, making it a power move for high-income earners. Each one has a clear purpose for a specific person.
So, as we wrap things up here, I want to leave you with this idea. Your mortgage isn't just a debt. It's the financial engine for what is probably your biggest asset. The repayment strategy you choose, it tells a story about your priorities, about your vision for the future. So the only question left is, what story is yours going to tell?